All right. Good morning, everybody. Well, I'm in California. I'm in Napa Valley. This is Steve Moses. Welcome to the Pinnacle Institute, home of trading and investing workshops. Today, we're going to talk about selling time for fun and profit. Selling time with options. I think options are the greatest thing ever invented, and it's the one asset class where you can make money. Potentially, if you're right, with one asset class where if you're trading, you can be profitable even if you're wrong directionally. And we're going to talk about that today because that involves when you sell options, you don't have to be right directionally. We've got some upcoming workshops. So I mentioned this is the Pinnacle Institute. And what we teach and what our reason for being is to help traders and investors, whether you're new or whether you have some experience and are a little more advanced. We have some 3 introductory workshops coming up over the next week, June 1st, 3rd, and 5th. And this is for people who are new to trading and or investing and who are unfamiliar with a supply and demand trading strategy. You may have heard the phrases support and resistance. Supply and demand is actually something quite different. We're looking to trade with the big guys. We're looking to trade with the people or the institutions that move the markets. And we look to teach how to identify market turning points. And that's a beautiful thing. All right. So if you're new and you've never traded on your own and you've thought, look, this year, back in January, when all that stuff with GameStop and AMC and Nokia was going on, a lot of people were jumping into trading. And to be honest, they really didn't know what they were doing. And a lot of those folks, some folks probably made some money every once in a while. A rising tide raises all ships. But a lot of folks didn't know what they were doing, may have been up big, didn't know when to take profits, didn't know where things were going to turn or potentially where they were going to turn, and ended up giving it all back and maybe taking a loss. And even in investing, many people are buy and hold investors, and you don't know when you want to hold. I mean, if you had held through the .com crash or the subprime mess, it's one thing to have a 401k, and then 6 months later it turns into a 201k. So you kind of want to know, even if you are going to buy and hold, when do you want to hold and when do you not? Also, for those who are a little more advanced, who have some trading strategies, trading experience, and maybe you've been introduced to supply and demand. We have some advanced workshops coming up also over the next week on June 2nd, 3rd, and 5th. So please join us to those. You can go to pinnacleinstitute.com/upcoming-events and look for us there. All right. So what we're going to talk about today is the topic for today is selling premium for fun and profit. That was the title of the YouTube session. And what does that mean, selling premium? Now, many of you have probably heard. We're going to go about 45 minutes to an hour today, and we're going to go to a brokerage platform. I'm going to pull up some charts in a few minutes and show you what I'm talking about. But we're going to talk about options, and we're going to talk about selling options. And before I get into that, let's just talk about for a second, why are we in the stock market? Simply put, we're in the stock market to make a profit. Okay, that's the only reason we're in the stock market, is to make a profit, and we want to be able to. That's the only reason we're in the stock market, is to make a profit, and we want to be able to. That's the only reason we're in the stock market. So to make a profit, and the reality is, most people think the only way to make money in the stock market is when the market goes up. You buy something. Think about how you make money in America. You buy something, the price goes up, and you sell it for a profit. Okay. Some people are aware of selling short. Some people are aware that you buy something, price goes up, you sell it for more than you pay for it. You sell something short, price goes down, and you buy it back for less than you sold it for. Okay. A lot of people don't understand selling short. A lot of people don't know what that means. Okay. To be able to sell short. First time I heard selling short, I thought it was a scam. You borrow something you don't own, you sell it, you don't go to jail. But we can make money to the downside. We can sell things that we don't own. Well, with options, we can also sell things that don't have any value. Okay, so if what do you mean? If a stock goes to zero and a stock has no value, you can't sell it. But there are options that have no intrinsic value. They have what we call extrinsic or time value. So it says time is money. And, so in that sense, time is money, and we can sell time. And we're going to talk about that in just a second. So why are we in the stock market? To make a profit. Believe it or not, that's the only reason. I've heard from a lot of people over the years why they think they're in the stock market. Well, I want to support companies and raise money and do that and to make a profit, and that's the only reason. Okay, I don't know about supporting people or doing anything else. I just want to make a profit. Okay, now, as I mentioned, I think options are the greatest thing ever invented, and we trade and invest in options for one reason: to make a profit. But as I said a minute ago, what if you could profit and not have to worry about being right directionally? What if you could profit even being a little wrong directionally? And let me just be clear what I mean by that. Being a little wrong directionally. Again, if you buy a stock, if you buy an asset, the asset goes up, you make money, goes down, you lose money. You short an asset, the asset goes down, you make money, goes up, you lose money. Most people who have traded and invested are directional traders, directional investors. You buy mutual funds. Over time, the mutual funds have to go up. You buy a house, the value of the house over time goes up. There are times where it didn't, 2008, 2009, during the Big Short era, if anybody saw that movie. But if you've never been exposed to options, okay, because in options, literally, time is money. Okay, and I don't just mean opportunity cost. You could have bought a stock 30 years ago for $50 a share. Today it's $50 a share and you broke even. And actually you lost purchasing power because of inflation. But for tax purposes, you broke even. Okay, so at the end of the day, with options, you can actually sell something that has no intrinsic value. It is literally worthless. But there is a time value component to the price or the premium of those options, and we can actually sell that. So by the ability to sell time, we can trade and be wrong directionally, meaning you could get into a bullish option trade, the asset could go down and you could make a profit. You could enter a bearish options trade, the asset could go up and you could make a profit. You could be wrong, just not really wrong on the direction. Okay, you can't be Enron wrong. You know, if the stock goes out of business wrong, you know, at some point, if you're that wrong, we're going to lose money. But how cool is it to enter a bullish options trade, and the option is a derivative of the stock? You enter a bullish options trade, the stock drops 5, maybe even 10%, and yet you're still able to make a profit. We're going to pull up some charts in a few minutes, and I'm going to talk about that, and I'm going to show you that. So the reason that I think the options are the greatest thing ever invented is because you could be wrong directionally to some degree and still make a profit. Because not only can you be wrong, you don't even need the stock to move. I talked earlier, a minute ago, about the stock you could have bought a stock a month ago at 50. The stock is at 50 today. Now, stocks don't flatline. The stock didn't just beep, beep, beep. It didn't flatline, but it may have gone up a little, down a little, up a little, down a little. But if the stock price today is where it was a month ago, you didn't make any money. You broke even, which is not the worst thing in the world, but you didn't make a profit, okay? But what if you could profit on a trade and you don't even need the stock to move? If the stock is in the same place in a month, you could still make a profit, because you don't need the stock to move when you sell option premiums. You just need the calendar to move, because options have an expiration date. So what we're talking about, and what we're going to talk about, is the ability to profit slightly wrong directionally when stocks don't even move, because while we're trading an option which is a derivative of the stock, The option has some component to it that the stock doesn't have, which is time value. And we're going to get to that in a second. So we don't need the stock to move. We need the calendar to move. Okay? So what if we didn't just trade stocks? What if we traded, you've all heard the phrase, time is money. Well, in the option world, it really is. I understand with a stock, time is money from an inflation perspective. Time is money for a purchasing power perspective. But at the end of the day, guys, if you buy a stock and the stock goes nowhere, you broke even. You're tying up capital. There might be lost opportunity cost on other investments if you have a small enough account and you can only do one or two trades at a time. And you can only do one or two trades at a time, then at the end of the day, I'm going to get to that, John. We're gonna do that. At the end of the day, okay, if you're trading time, when you trade options, what you're actually doing, if you buy options, those are directional trades, okay? There may not be any movement in the market, John, but there's going to be movement in the option premium. I'm going to explain that in a second, because what we're trading is time, okay? Now, what if we sold assets that as time went by, the assets deflated in value and potentially expired worthless? Now, I want to be clear about something. Stocks don't expire. Stocks don't expire. I don't mean, Enron, every once in a while a company goes out of business. Every once in a while a company will go out of business. A company will go private. A company will get bought out, or anything else might happen. I mean, a stock doesn't have to be there forever. Granted, IBM has been a publicly traded company since the 30s or 40s. GE was one of the original Dow Jones stocks. When Mr. Dow and Mr. Jones created the index, there were only 12 stocks. I think it was 1896. GE was one of the original Dow stocks, and it was still in the Dow until a few years ago when they took it out. But it has been publicly traded in this country for 125 years. Your great-great-grandparents could have bought shares at GE, passed them down, and profit or loss notwithstanding, you still own those shares. Options, though, are unique. Stocks don't have an expiration date, assuming the company stays in business and stays public. You can own stocks forever. But options have an expiration date. Just like an insurance policy has an expiration date. Now think about it. When State Farm sells you a car insurance policy, they collect a premium, and every day that goes by on that insurance premium with less time till expiration, the value of the policy is deflating. Does that make sense? And then when your insurance policy expires and you didn't file a claim, it expires worthless. Now, whether you renewed the policy or not is not what I'm talking about. Does that make sense? So how does State Farm make money? They sell you a policy. Now think about this, John. How does that happen? How do you make money when there's no movement? Think about insurance for a second. State Farm or Allstate sells you a car insurance policy. They sell you a homeowner's policy. They sell you a policy, you mail them a check. What has to happen for them to keep the check? What has to happen for them to keep the premium? Nothing. Nothing. You don't have an accident, you don't file a claim, they keep the premium, which eventually expires worthless. I mean, how does it work in America? At the end, when your car insurance policy expires, if you don't have an accident, they give you the premium back, right? No. Think about this. Apple sells you Apple makes money by selling you a product. They have to deliver a product. Costs them money to make the product, they sell it for a profit. GM makes a car, costs them money to make the car, they sell the car for a profit. IBM used to sell computers, cost them money to make the computer, they sell it for a profit. They're selling you something that has intrinsic value. They're selling you something that costs them to make, and they're selling it for a profit. But when State Farm sells you an insurance policy, they didn't sell you anything physical. They sold you peace of mind. They sold you an obligation to do something if something happens. If you have a car accident, you file a claim. If your house burns to the ground, God forbid, you file a claim. Life insurance, if God forbid you pass away. Does that make sense? But how do they keep the premium? How does an insurance company make money? An insurance company sells you something. They sold you a policy. And as time went by, getting closer to expiration of that policy, the value of the policy deflates. Eventually, you get to expiration. The policy expired, worthless. They made money, and nothing happened. Does that make sense, John? So just like the insurance company, we're going to sell time. Now, the insurance company sold time. They also sold an obligation. They took on an obligation to buy your car if you cracked it up. They took on an obligation to buy your house if it burned to the ground. Health insurance, they took on an obligation to cover you if you get sick. You can insure anything against risk because the person who sold you the policy took on an obligation. Okay, well, with options, when you buy options, you're buying something that probably has value. If any of you are familiar with options, a call option gives you the right to buy a stock at a set price, no matter how high it goes. A put option gives you the right to short a stock at a set price, no matter how low it goes. So when you buy options, you're usually buying in the money options. They have intrinsic value, and that's fine. Those are directional trades. Those are what you're used to. However, when you sell options, what you're selling is an obligation to either buy or sell stock in exchange for collecting a premium up until an expiration date. So when we sell options, we're going to sell an asset and collect premium. That asset will deflate in value every day until the expiration date, until they expire. And the plan would be that they expire worthless. Look, when you buy car insurance, you hope you don't have an accident, right? Any insurance you've ever bought, you never hope to have to file a claim, right? I don't imagine anybody on this webinar today is sitting there going, gee, what a bummer. I haven't filed a life insurance claim this year. You don't sit there and go, gee, my car insurance expires tonight at midnight. I better hurry up and get to an accident. You buy insurance for peace of mind. You hope you don't have an accident, and the insurance company hopes you don't have an accident, so they get to keep the premium. Okay, that's the concept of what we're going to do, because options have something stocks don't have. Options expire. They will expire. They have an expiration date. It's usually on a Friday. We'll look at the option chain in a minute, but options expire every week on Friday. Now, when I started trading almost 20 years ago, 17, 18 years ago, there were only 12 expiration dates a year. There were monthly options. They expired on the third Friday of every month. And then about 8 or 9, 10 years ago, whatever it was, options had proved very popular, and they came up with weekly options that would expire every Friday. Weekly options became even more popular, and now there's an options expiration date every Friday for the next 7 weeks. So basically, and matter of fact, on some ETFs like the SPY and the QQQs, those are the ETFs of the S&P and the NASDAQ, the options on the indexes and the options on the ETFs, they now have expiration dates on Monday, Wednesday, and Friday every week, unless one of those days is a holiday. If a Friday is a holiday, then the expiration date would be Thursday, but that's a conversation for another day. So options expire, okay, unlike stocks. And here is an option chain. Okay, here's a picture, and this is Facebook. This was earlier this week. So as we're looking at this picture here, Facebook was trading at $331.28 a share, and we're looking at options that expire on June 18th, which is in a month or 22 days. Okay, and notice it says intrinsic, and there's some numbers below it. It says extrinsic, and there are some numbers. And then all the way over here on the right, those are the strike prices. Those are the options. Those are the coupons. So as I mentioned before, notice, let's look at a 340 strike coupon right here. Intrinsically, that option is worth nothing. Now, why is it worth nothing? Let's talk about this for just a second. The stock is trading at $331.28. Okay, A 340 call option gives you the right to buy Facebook stock at 340 a share. Well, wait a second. Why am I going to buy an option giving me the right to buy Facebook at 340 a share if I could go out in the open market and buy Facebook for 331 a share? You're right. That option has no value intrinsically. However, there's 22 days till expiration. Okay? There's 22 days till expiration. So this premium, this $4.25 right here, that $4.25 is what we call extrinsic value or time value. We're paying $4.25. If you were buying this option, you're paying $4.25 for the right to buy Facebook for the next 22 days at $3.40 a share. But you're buying something that intrinsically is worthless, but what you're buying is the hope that the stock is going to go up. What you're paying for is time. Now, just like stocks can be bought or sold, you can buy to open shares of stock and go long. You can sell shares of stock short and sell shares of stock to open and be short. Okay? Wow. Okay? Well, options can be bought and sold. You can buy to open an option, buying the right to do something, or you can sell an option that you don't own, just like you can sell shares of stock that you don't own. Now, if we sold this option, what if we sold a 340 call option on Facebook? Well, we're going to collect $4.25. Just like when you sell, if we shorted Facebook stock right now at 331.28, you shorted 100 shares of Facebook, they would give you $33,128. They would deposit that in your account. You sold the shares. Yes, there's margin required, and you're going to have to buy to close those shares to close the trade. You have to have approval from your broker to sell short. The shares have to be shortable, all separate conversations. If you shorted Facebook stock at 331.28 a share, they're going to deposit $33,128. Now, you are obligated to buy those shares back at some point. Okay. If we sell a 340 call option, that obligates us to sell shares of Facebook at 340. Who are we going to sell them to? The person who bought the 340 call option. Now, why would somebody buy a 340 call option? Well, what if somebody thinks that in the next month, Facebook is going to 360 for whatever reason? You think Facebook's going to 360 a share. So if you bought a 340 call option, you bought the right to buy Facebook at 340, no matter how high it goes. Think of a supermarket coupon. You have the right to buy a product at the coupon price, no matter what the price is when you walk into the store. Does that make sense? Okay. Now, if Facebook goes to 360 before this expiration date, before June 18th, Facebook goes to 360. You bought a 340 call option. You have the right to buy a $360 stock for 340. Wow. And if you bought a stock at 340, if you exercised your option, you bought the stock at 340, sold the stock at 360, you're going to get $20. What did you pay for the option? $4. You're going to make an almost $16 profit, $15.75 on expiration day. That's a 400% rate of return. Now, if you bought the stock at 340 and sold it at 360, you still made $20 a share, but you had to buy the shares for $34,000. We could buy this option for $425. Options are sold in contracts, gang. So if you see a 340 call option for $425, that's times 100. One $340 call option would cost you $425. To buy 100 shares of Facebook at $340 would cost you $34,000. So you could either buy Facebook shares, 100 shares for $34,000, or a call option or a coupon giving you the right to buy Facebook for $425. If Facebook goes to 360, the stock you bought for 340 and sold for 360, you made $20. It's about a 7% rate of return. You made $2,000 on your 100 shares, 7% rate of return. However, if you bought a 425 call option and got to sell it for 20, you made 1,500. You didn't make 20 bucks. You only made 1,575. But that's almost a 380% rate of return, and you only had to invest $425. Now, if Facebook goes to 360, why do you get to buy it at 340? Good question. Because the person who sold you the 340 call is obligated to sell you Facebook at 340. Just like State Farm is obligated to write you a check for 50 grand if you total your Mercedes. Your car is worthless. They're cutting you a check. Why? Because they're obligated. So if we sell a 340 call option and the stock goes over 340, we may have to fulfill our obligation and sell Facebook at 340. But what if Facebook never goes above 340? Then the person who bought the call is never going to exercise the option. We will never have to fulfill our obligation. And what do we get to keep? The 425. What do we have to do? Nothing. Are you with me? So this option, this 340 call option, is intrinsically worth nothing. What it's worth is time value. What it's worth is a promise, potentially. Does that make sense? Now, you can't sell any other asset that's worth nothing. You can't sell a stock that's worthless. You can't sell a futures contract that's worthless. If a stock goes to zero, you can't even sell it. It's worth zero. Your house burns to the ground, it's worth zero. Maybe there's land, but you can't sell the house. House is destroyed. Tornado just took it out, God forbid. So any other asset, you can sell the asset if it has value, but that's it, okay? But with options, because options have an expiration date, because there is time between today and the expiration date. So if Facebook is trading at 331.28, every one of these strike prices over here, starting with the 332.50 strike price, any strike price above the stock price, that option has no intrinsic value. If somebody bought a 332.50 call option and exercised it, and bought the stock at 332.50 and sold the stock at the current price of 331.28, they're losing $1.22. There's no intrinsic value. Now, if you bought a $320 call option and sold the stock and exercised that and bought the stock at 320 and sold the stock at 331.28, okay, now you're getting some money. You're getting $11. There's $11 of intrinsic value there. And you can see it here. A 320 call option has $11.28 of intrinsic value. But all of these strike prices above the current stock price, no intrinsic value. And yet, because they have premium, it's not worth zero. So if a stock has no intrinsic value, you can't sell it because stocks don't have time value. Stocks don't have extrinsic value. Futures contracts don't have extrinsic value. Forex lots don't have extrinsic value, but options, because of the expiration date, you're paying or selling time. They have extrinsic value. Okay, those are called out-of-the-money options. Now, because options have an expiration date, all options will expire and most will expire worthless. So let's just go back 1 second. So when you look here, now if you're buying this 340 call option, okay, I don't know if Apple stock is going to get to 340. If you buy Apple stock today at 331, and let's say Apple had a supply zone or a resistance area at 350, and you're buying Apple stock today at 331 because you're hoping to sell it at 350. Okay, do you know if Apple stock is going to get to 350? The answer is, of course, no, you don't. Any investments you get in, you don't know if it's going to work out. There's no such thing as a guaranteed trade, guys, okay? Just to be clear, okay? There is no such thing. Nobody is right 100% of the time. Warren Buffett is not right 100% of the time. Pinnacle method is not right 100% of the time. You're going to have losing trades. I can guarantee that, okay? However, every trade or investment you've ever gotten into You are getting in because you're expecting something to happen. If you buy a stock, you're expecting it to go up. If you're shorting a stock, you're expecting it to go down. Okay. If you bought a Facebook stock on this day at 331.28, you're expecting to go up. We don't know if it's going to go up. I mean, if I knew that Apple stock was going to be at 350 in 3 weeks, if I could guarantee that, would I be here talking to you? Or would I be backing up the truck somewhere? If I could guarantee, if I had a listing of Facebook's closing price on New Year's Eve this year, man, I would just borrow every dime I could get my hands on and back the truck up. And if it was higher than where it was today, I'd buy 1 million shares if I could get my hands on that kind of money, if I could guarantee where it's going to get. Well, the reality is, while we can't guarantee where the stock is going to go, guess what we can guarantee? That June 18th is going to get here. This is very important in selling premium. I can't guarantee whether Facebook stock is going to go up or down. I can't guarantee if it's going to get to an opposing target for a profit or if you're going to get stopped out. I can't guarantee if Facebook stock is going to do a thing. I don't know. But what I can guarantee, absolutely guarantee, is that June 18th at 4 o'clock Eastern time, 1 o'clock Pacific time, June 18th, market close is going to get here. And if June 18th doesn't get here, we have bigger problems than our call option at our Facebook stock. Are you with me? Now, I want you to think about this. What if we sold a 340 call option today and collected 425? We're not saying that Facebook is never going to go over 340. But what if we're saying it just has to not go over 340 in the next 22 days? That's different. What if Facebook had a supply area below 340? See, when you sell option premium, what you're doing is you're trading where you think the stock is not going to go. See, most of you, if you've never sold options, you've always traded based on the expectation of future movement. You buy a stock for one reason. You think it's going up. You're expecting it to go up to the next resistance area, the next supply area. You're expecting it to go up. You're shorting a stock because you're expecting it to drop to demand or a support area. That's the only reason you're buying or shorting stock. That's the only reason you're buying or shorting futures contracts or real estate or anything as an investor, not as a place to live. Okay? But what if we saw, because you're expecting the stock to go somewhere directionally. But what if we sold options above a resistance area, above a supply area? I mean, above a resistance area, above a supply area, or we sold options below a support area or below a demand area? What if we sold options where we didn't think the stock was going to go? Because, by the way, guys, check this out. Between now and June 18th, if Facebook never goes above 340, this option that we just sold for 425 would expire worthless. If the stock never goes above 340, this option will never have intrinsic value and it will expire worthless. Just like if you never have a car accident until the policy expires worthless. Right? How cool is that? So when we sell options, literally with options, time is money. This option is worth $425 because we're selling 22 days of time. Okay, so we're going to sell a 618 with 331.28. We're going to sell a 340 call for about 425. Okay, on Facebook. And we'll look at the option chain in just a second. Now remember, the stock could go up or down. I don't know. But what I can guarantee you is if on June 18th at market close, Facebook is at 340 a share or less, this 425 premium will be zero. Now, an option going to zero, is that a good thing or a bad thing? Well, if you bought an option for 425 and it went to zero, you just took 100% loss on your trade. That stinks. But if you sold an option for 425 and the option expired worthless, you just got 100% profit. Just like if you buy a stock and it goes to zero, you lost everything. If you shorted a stock and it goes to zero, you got the max profit you could get. Does that make sense? That's the difference between stock and options. Options will expire, guaranteed. Now, some options, like today is May 28th. There are options that expire today. There are options that expire in 2.5 years, but they will eventually expire. And according to the CBOE, the Chicago Board Options Exchange, approximately, and it varies from month to month, but approximately 80 to 85% of options expire worthless. Those numbers, are tweaked based on what's going on in the world and in the market, but approximately, depending on who you ask, 75 to 85% of all options will expire, separate from whether they were closed for a profit or a loss, will expire worthless from what I've read. Okay, now let's talk about out of the money options. Okay, now when I come over here to Thinkorswim, okay, I'm actually on Thinkorswim. I don't really care what brokerage platform you use. So let's pull up. So here's Facebook. Okay, now we were just looking at Facebook. So when I put these slides together a couple of days, so Facebook is down today. Now notice, here is your June 18th option, only expires in 21 days. Okay, so let's open up the option chain and let's scroll down to our 340 call option. Well, take a look. This option now is trading $4 by 410. Everybody see where my cursor is? Look at that. Now, I put that slide together yesterday. So yesterday, let's go to intrinsic value, okay? Yesterday, this 340 call option that we could have sold for $4.25. Today, the mid price is 405. If we sold that option yesterday for 425 and bought it back a minute ago for 405, we made a profit, even though the stock went down. Now, again, I don't know if the option is going to be in the money. I don't know if the stock is going to be over 340 3 weeks from today. But let's pull up a chart. Okay, so let's look at Facebook. All right. Now, by the way, this is not a recommendation. This is just for example purposes to explain options. Now, this isn't really a classic supply zone, but it's an all-time high on Facebook that we've been threatening to rally above. So let's say we sold a 340 call, expiring in 3 weeks. If all Facebook does is just hang out up here or eventually pulls back a little bit, okay, and actually pulls back a little bit and just doesn't go over 340, which is up all the way up here. 340 is all the way up here. All we would need to have kept that 425 is for Facebook to stay under 340. Does that make sense? And I just want you to think about that. We're selling where we don't think it's going to go. Now, you can do this to the upside and you can do this to the downside. So let's go back a few weeks. Down here on May 12th, when Facebook was trading around 300. Okay, here's a demand zone that I have on my chart. This demand zone is between 296 and 302. Between 296 and 302. 302 is the proximal line. 296 and change is the distal line down here. Where is 295? 295 is below the distal line of this demand area. Now, let me ask you a question. When the stock got to the demand zone, if I asked you, are you bullish or bearish, what would you say? Well, you'd say you're bullish, whether it's a support area, a demand area. The stock, a downtrending stock, has hit a demand area. Our supply and demand method that we teach at Pinnacle is to how to identify market turning points, how to identify where the unfilled buy orders are sitting. Does that make sense? Okay, so if we're doing that, okay, well, think about it. We all want to buy. Let's say you're a bullish investor. You're a stock trader. What's the secret to the stock market, guys? It's pretty simple, right? Buy low, sell high. That's it. Thanks for coming. We're done. Buy low, sell high. Well, the problem is, in order to buy low, what direction does the stock have to be going in? It has to go down. Well, in order to buy low, how many retail traders, how many people who don't understand market turning points, how many people don't understand where a downtrending stock is going to stop going down? Because what a lot of retail traders do is, well, I could have bought the stock up here at 331. Well, I can buy it here, buy low. Well, it's at 319. It's a lot lower than 331. It's down here at 309. It's a lot lower. So I don't really like buy low and sell high as a phrase, because define low and define high. I know pot's legal today, but there's still a different definition of defining high. Okay, define low, buy low, sell high. I don't like that phrase, buy low, sell high. You know what phrase I like? Buy and sell higher. Because what's low? To somebody, a $300 stock, but by the way, 331 to 310, 310 is low. But is it done going down? What you want to do, if you want to buy low and sell high, or buy and sell higher, wouldn't you want to buy something before it stopped, right where you think it's going to stop going down? Where is the safest trade to make? Right here. If you could buy Facebook at 296, if you're wrong, you get stopped out down here at 295, 294. That's the smallest loss you could take. If you got in right here and you're wrong, you get stopped out right down here. But if this demand zone holds, the stock shouldn't even get to 295. Does that make sense? So let me ask you a question. Market turning points. Why did Facebook stop going down right here? Simply put, why did Facebook stop going down right here? Because we ran out of sellers and there were buy orders there. Had to be. Had to be. That's the only answer. If there weren't enough buy orders here to absorb all the sellers, what would Facebook stock have kept doing? Kept going down, kept going down, kept going down. By the way, you go back to March of last year during COVID, when the market started hitting the fan. Look at this. Facebook went, this was March of last year when COVID was going on. Facebook went from 220 to 130 something. There were no buyers. There was a demand zone here, but the buyers disappeared. No buyers, no buyers. Or there were buyers who kept saying, well, it can't go any lower, can't go any lower, can't go any lower, can't go any lower. Buy low, sell high, can't go any lower, can't go any lower. Okay, so let's come back to our area here. All right, so here we go. Facebook was coming to an area where we thought it was going to stop dropping. Why did we think it's going to stop dropping? Because we thought there were buy orders in this area. There were buy orders here, 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 here. There must be a ton of buy orders here because the stock since May 12th has gone from 300 to 330. The stock has gone up 10%. Now, do you think these were retail buyers or institutional orders? Obviously, institutional orders. There had to be enough institutional order flow down here, leftover buy orders, to absorb all the sellers of this $330 stock dropping 10 points. This is where we thought the stock was going to stop dropping. So, if this demand zone held at 296, like it did right here on this red candle, if the stock doesn't go below 296, can it touch 295? No, I didn't say can it go below 296. I said if it doesn't go below 296, can it get to 295? And the answer is no. So what if when Facebook came down here a few weeks ago, 2.5 weeks ago, we sold a 295 put? So before, we just sold a 340 call because we didn't think Facebook was going to 340. Well, as I explained a minute ago, when you sell call options, you are obligated to sell the stock at that price. When you sell put options, you are obligated to buy the stock at that price. Well, wait a second. If we're going to sell a put option at the 295 strike price, that means that somebody else had to buy the 295 put option. They bought the right to sell Facebook at 295. Okay, well, if the stock was up here at 300, Who's going to sell the stock to us at 295 if they can sell it on the open market at 300? Answer, nobody. So if I sold a 295 put and collected a premium, that put has no intrinsic value. That put is worthless intrinsically. Just like the 340 call is still worthless. Look at this. The 340 call is still worthless. It has no intrinsic value. And this option will never have intrinsic value until and if the stock goes over 340. Well, back when the stock was at 300, a 295 put had no intrinsic value and was worthless. And that put would never have intrinsic value if and until the stock goes below 295, which we don't think it's going to do because that's our demand zone. Now, again, one more time for compliance purposes. I'm not saying that Facebook couldn't have gone below 296 or 295. Facebook was at 270 in March. I'm not saying this stock will never go below this area. But the probability is for the next week or two, well, look what it's done. So I placed the trade in our Pinnacle Institute back here. We sold 295 puts and collected premium. Now, we actually turned it into a credit spread and we bought another option, but which I can't explain today. But we sold 295 puts that expired within less than 2 weeks. Because on May 12th, May 12th was a Wednesday. So we sold puts expiring last Friday, May 21st, which would have been right here. So on May 12th, we sold 295 puts that expired right here. Okay, now we sold these puts for a premium. Did the stock ever get to 295? Nope. Almost came back, but we sold those puts and the stock went up. And on May 21st at market close, the stock was 20-something points above 295. If we had sold those puts, they would have expired worthless. So remember what I said a half an hour ago. If you sell options, you don't need the stock to go up or down. You don't need to be right. You just don't need to be wrong. See, if you bought stock here, you needed the stock to go up. If you bought Facebook stock at 300, stock goes up, you make a profit. Stock goes down, you take a loss. Cool. If you shorted stock up here, stock goes down, you make a profit. Stock goes up, you make a loss. Okay. But when we sold a put, when the stock was here, we didn't need the stock to go up. We just needed the stock to not go down. Look back here. What if we did the same thing back here on April 19th? What if we sold the same 295 puts? The stock actually did go down, but never got to 295. So all of this time went by. The stock never touched 295. We didn't need it to go up. We just needed it to not go down. Does that make sense? And that's how you sell time. You don't need the stock to go up if you sell puts. You just need it to not go down. And by the way, so John's question earlier, how does that happen when there's no movement? Well, look at this. From April 14th to April 27th, for almost 2 weeks, Facebook was trading at the same price. Remember what I said before? Stocks don't flatline. But the stock was at 303 on April 14th. It was at 303 on April 27th. 2 weeks went by, and the stock was in the same place. Yeah, it went up a little, went down a little, came back. But if we sold options here, the stock didn't move net, but 13 days of time, the calendar moved. Does that make sense, everybody? That's what's so amazing about options. This is why I think options are the greatest thing ever invented. If anything I'm saying is floating your boat, join us in one of our workshops, okay? Because before you learn about options, what you need to learn is where you think a stock is not going to go. Just like as directional traders, if you want to buy low and sell high, you'd like to buy a downtrending stock right where you think it's going to stop going down. you'd like to short an uptrending stock right where you think it's going to stop going up, right? So if you're trading directionally, if you want to buy low and sell high, then you need to know where it's going. In order to buy low, you need to know where it's going to stop going down. And in order to sell high for a profit, you'd like to sell where you think it's going to stop going up. Because what if Facebook comes up here and in 3 weeks is back here at 300? Is that a possibility? Of course it is. The only thing that stinks more than a winning trade is a winning trade we let become a losing trade. What if you bought shares of Facebook down here at 300, stock went up to 330, you didn't sell them for a profit, and then the stock came all the way back to 300 and then dropped to 280? You not only gave up $30 of profit, now you're taking a loss. So if you don't know when to get in and don't know when to get out, I don't know how you trade. I mean, yeah, you could follow Jim Cramer. He could throw a chair at the screen and go, booyah, I'm bullish on this stock. Or I read an article in Barron's, or I read the Wall Street Journal, or whatever methodology you use. But that's what the Pinnacle methodology is, supply and demand. Let's trade with the big guys. Let's try and find those market turning points on whatever asset you're trading, futures, forex, stocks, options. So while this is an option trade, it's predicated on the stock movement or non-movement. Does that make sense? So if we're entering a bullish options trade on Facebook, we're only doing that for one reason, because we're bullish on Facebook. If you're entering a bullish options trade, you better be bullish on the stock that the option is a derivative of. If you're entering a bearish options trade, you better be bearish for a reason, and it better be because the stock is out of supply zone. Okay? You better be entering a bearish trade where you think it's going to stop going up. Now, let me show you something. Let's pull up Netflix. Okay, and this is a few years ago. Look at this chart on Netflix. Okay? Now, say what you want. Why did, boom, 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 boom. Look at this area between 375 and 385 on Netflix. For a year and a half, from July of 18 to February of 20, for a year and a half, this stock never went over 385. How many times did we come up to this supply area? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 times. Now, we know eventually it did because it's trading at 500 today. But for a year and a half, this stock never went above this area. Now, by the way, look over here. For most retail traders, when the stock came up here to 380, if I had a supply zone right here, who's buying the stock right here at 380? Someone who thinks it's coming all the way back up here to 420, right? You learn support and resistance. The only reason someone's buying, why do you buy a stock? Because you think it's going up. What do most technical analysis books teach you? Well, the stock's going to come. It came up there once, came up there a second time. It's going to come back there a third time. Well, there's a difference between resistance and supply. Now, I can't get into all of this today, but we were right because the stock for a year and a half never got back to 420. So if you wanted to short Netflix at 385, you could have done it 1, 2, 3, 4, 5, 6 times. If you wanted to short it up here at 380, you could have done it 10 or 12 times. Who's buying a stock at supply at 380? Rookie retail traders. But here's the thing, guys. What if every time Netflix came up here, we sold call options up here at 390 or 395 or 400 and collected premium? Now, yes, the stock did tank a few times, but what about here? It didn't really tank. It didn't go down a whole lot. It just didn't go up. Didn't go down a whole lot. It just didn't go up. Wow. Do you understand what I'm saying? Okay. So when you see stocks, how about this one? Let's pull up BIB. Look at this. This was this was almost 2 years ago. Look at this chart. Look at this chart. For 7 months, what did this stock do? Boom, 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 boom. For 7 months, this stock didn't go below 215 or above 245? Who keeps buying the stock up here at 245? Who bought the stock here, 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 and here? Who shorted the stock here, 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 or here? I don't know. Rookies. But what if every time the stock came down here, we sold 215 puts below the distal line of this demand zone, collected premium, they expired worthless? What if every time the stock came up here to 240 or 245, we sold 250 call options? 250 is up here. Now, eventually, the stock did blow past 250. Okay. But for 7 months, do you know how many times I took trades on this? Every time it came down here, I tried to profit for it to not go below there. Every time it came up here, I looked to profit for not going up there. And if I did go into that trade one more time and took a loss up here, 10 winning trades, 1 losing trade. I'm okay with that. Same with Netflix. Okay? You know, we come back to here on Netflix, because by the way, finally, over here, 21 months later, Netflix finally blew past this zone. Finally blew past 385 last April in the post-COVID renaissance. But for a year and a half, boom, 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 boom. So when you sell premium, what you're doing is you're basically trading where you think is not, where a stock is not going to go, either above a supply area or below a demand area. You're going to sell options that have no intrinsic value, and you're going to sell time for a relatively short period of time. Does that make sense, everybody? Wow. How cool is that? Okay. Now, you've got to know when to do it. You know, I mean, you don't want to be, you know, in a raging bull market, you know, you certainly don't want to do bearish trades. But every time something pulls back, using supply and demand makes options so much simpler. Absolutely, Mark. Okay. You know, it's funny. People make options so complicated. I finished yesterday. This week, I taught the first Pinnacle options class. I designed it. I created it. And we taught the first Pinnacle options class. And it was a big success. By the way, today is May 28th. It's the Friday before Memorial Day. 17 years ago today, I started my trading journey with a company that doesn't really exist anymore. My wife and I had gone to a workshop. They taught people how to trade. They didn't use supply and demand. They used arrows and MACDs and stochastics. They used all these lagging indicators and blah, blah, blah. But I started my journey as a retail options trader on the Friday before Memorial Day, 2004. I was the associate publisher of United's in-flight magazine, Hemispheres. I had been in publishing for 20 years, and I was exposed to options for the first time 17 years ago today. And I learned how to do this. And most of the people that I saw teach options over the next 10 years, as Mark says, makes them complicated. There are market makers. There are engineers. There's a lot of math in options. I mean, look, guys, I explained this today from the 5,000-foot view, okay? I didn't teach you how to do anything. We just talked about what's possible. But too many people who teach options explain it in a way that could put your head in a knot. I teach options as a retail guy. I start with the concept. I talked about a supermarket coupon. I just talked about selling options, selling premium, taking on an obligation. John asked, how do you make money when nothing happens? Think of an insurance company. That's it. Think of that concept. You have a coupon says you can buy a bag of Doritos for 99 cents. You walk in the store, the Doritos are $5.99. You get to buy them for 99 cents. You have a coupon that says you can buy Facebook for $3.40 and Facebook is at $3.80. Why can you buy a $380 stock for $3.40? The same reason you can buy a $5.99 bag of Doritos for 99 cents, because you got a coupon, and the coupon has an expiration date. So there you go, Mark. We keep it simple here at Pinnacle. That if you understand the concept of options, now I'll just to be fair, options do have a higher learning curve than the other assets. Not that they're hard, but they have a slightly higher learning curve. I mean, think about what I said an hour ago. If you can be wrong directionally and make a profit, that means you can be right directionally and take a loss. Options have some different moving parts than other assets. I'll give you that. But while options may have a slightly higher learning curve, while they might not be the easiest asset class to learn, you will all learn them if you want. But I think they're the easiest to trade. But you're not trading them in a vacuum. As Mark just says, you have to understand supply and demand. You have to understand, why am I getting into a bullish options trade? Because as much as options are leveraged, guys, biggest mistake retail traders make. Who do you think went bullish right up here? Who do you think went bearish right down here? Somebody went bullish after the rally in price. Somebody went bearish after the drop in price. That's retail. That's people trading the news. What we teach is we go bearish where we think an uptrending stock is going to stop going up. We go bullish because where we think a downtrending stock is going to stop going down, because we think we found the unfilled institutional orders. How cool is that? So if you understand supply and demand, that will just make you a good trader. Then you have to learn the specifics of options. Because guys, let's go back to to Facebook. Okay. All right. I mean, look how many expiration dates there are for Facebook. All the way out to June of 23. See, if you want to trade Facebook stock right now, it's at $331.67 a share. That's it. If you want to trade the stock, it's a yes or no question. Do I buy the stock? Do I short the stock? To buy or not to buy? Hamlet was the first stock trader. There you go. Okay. You're either buying the stock at demand, you're shorting the stock at supply. It's a yes or no question. That's it. But if you want to buy a call option for Facebook, do you buy one expiring today? These options expire today. These options expire in 749 days and 25 months, all the way down here. Which expiration date do you choose? Once you choose an expiration date, look at how many strike prices there are, in the money, out of the money. Which expiration date do you choose? Which strike price do you choose? Are the option premiums inflated or deflated? There's so much we haven't talked about today. Okay? But when I teach the options course, I will explain all of those, not complicated, but all of those harder to explain in the beginning concepts very simply. And what I promise is that when you finish our options course, what I can guarantee is that when you finish our options course, you will know what options trade to place. I'm not guaranteeing you a profit, but I'm guaranteeing you'll have a checklist. You'll have a template and a checklist to find the right option trade to place based on your assessment of the market. Now, if you're wrong on your assessment, if you're trying, if you're entering a bearish options trade down here, you may find you'll still choose the right option, but it's the wrong trade, because you shouldn't be bearish down here. Okay, you shouldn't be bearish on Facebook down here. Okay, look at Tesla. We placed a trade in our Coliseum last week. Look at Tesla. Say what you want about Tesla. Boom, boom, right here. Now, one of the nice things is Tesla was a $550 stock on May 19th last week. And look at how it reacted to this zone. Look at this. Kissed the proximal line. Didn't even get that far down. And we went looking to sell premiums. We went looking to sell a put option down here last week. Sell a 520 put option when we didn't think the stock was going to go below 540. Now, we're almost out of time. I'm going to leave you with this. So if this sounds very cool, wrapping options overlaying options over supply and demand. Here's the other thing you can use options for. I don't know how many of you trade stock. Okay. But I just told you that selling puts obligates you to buy a stock. I like to sell puts below where I think the stock is going to go, because I want to sell puts for profit. I don't want to buy stock. But what if you wanted to buy Facebook? What if on this day, down here, you said, you know what? Here's the proximal line of a demand zone. If you wanted to buy shares of Facebook at 250, and the stock was up here, you could wait for Facebook to come to 250 and put in a good till cancel limit order to buy 100 shares of Facebook at 250. Okay. If you want to buy 100 shares of Facebook at 250, what if you sold a 250 put? Now you collected premium and you're getting paid to buy the stock at 250 if it gets there. Wow. Wow. And how about Netflix? Let's come back to our little chart here. What if you own shares of Netflix and you were willing to sell your stock at 385? How about instead of selling calls up here, you sold calls at 385? If you were willing to sell your stock at 385, why not get paid to sell your stock at 385? So you could get paid to buy your stocks at demand for a discount, and you can get paid to sell your stocks at supply for a premium by knowing where and how to sell options. So you can sell options without owning stock just for profit, or you can sell options to buy and sell the stocks you want to buy at the price you want to buy or sell them at. How amazing is that? But remember, you need to understand how options work. There are more moving parts with options because, as I talked about, as John noticed an hour ago, you can make or lose money with an option trade with the underlying stock not moving. Because remember, the underlying stock may not move, but the calendar is going to move. Okay? The calendar is going to move. All right? Your options are going to expire. Okay? That's a guarantee. All right? I mean, at the end of the day, guys, right here, in this first example we started talking about Facebook on, June 18th is going to get here. Guaranteed. Okay? I don't know where Facebook's going to be on June 18th. I don't know where Netflix or Tesla. I don't know where the market's going to be. I don't know where I'm going to be on June 18th. But I know June 18th is going to get here whether I'm here or not. Whether Facebook is at or above 340, at or below 300, June 18th is going to get here. And when you sell options, they will expire and they will decay every day between now and expiration. And if you sell out of the money options and those options stay out of the money, they will expire worthless. Cool or cool? Okay, boys and girls. So thank you for joining us today here at the Pinnacle Institute, the Pinnacle Method for Trading and Investing. As I mentioned, we have some really cool workshops coming up. You know, you may be such a new trader, you can't even spell options yet or stock yet. Then these introductory workshops on the left next week are for you. If you think I explained options fairly simple today, we will explain what the Pinnacle Method is all about in a very simple format. Trading is really not that hard when you learn how to do that. Time to drink wine, Raphael. Well, not really. It's only 10 o'clock where I am on the West Coast. If I start drinking wine at 10 o'clock, I'm going to have to start going to meetings. But there's the link to register for one of our workshops. Please, or the link is coming up. Please take a look at that. And if you are brand new and you would like to learn market timing, supply and demand, let alone then learning how to trade stocks, futures, forex, or options, we have some phenomenal instructors. I know it's 5 o'clock somewhere, Raphael, but I'm not drinking at 10 o'clock. All right. We have phenomenal instructors with tons of experience who will explain things to you, in ways that make the market less complicated. And if you have experience, when I said I started my trading journey 17 years ago, literally today, the Friday before Memorial Day of 2004, this company didn't teach supply and demand. They taught support and resistance, and they used all the lagging indicators, MACDs and stochastics and moving averages and CCI and RSI and, NFL and CBS and all this stuff. I'm kidding. But, and I thought I knew what I was doing, but I was trading off of lagging indicators, not trying to find the institutional order flow. Because remember, when I showed you where my supply zone was on Netflix, just to leave you with this, my supply zone on Netflix was not a resistance level up here. My supply zone on Netflix was established here, not the resistance level all the way up here. That's a huge, somebody kept buying Netflix up here. Somebody kept what is the definition of insanity? Doing the same thing and expecting a different result. For a year and a half, somebody kept buying Netflix at 380 or 385. That's the definition of insanity. to me, okay? And we will explain our supply and demand methodology. Even if you're experienced, and maybe you even have some supply and demand experience, we'll explain that. And we'll show you how to use supply and demand to identify those market turning points. Then you will learn to overlay whatever floats your boat. You want to intraday trade futures? You want to trade forex? You just want to trade stock? Or you want to learn how to spend some time with me and learn how to trade options, the greatest thing ever invented, okay? All right, guys, gals, thank you for your comments. Thank you for joining us today. There in the chat box is the join us at our website, pinnacleinstitute.com/upcoming. Well, whatever that link is there. I can't see the whole thing. Would love to see you, and would love to see you in some of our workshops, guys. It's we got a holiday weekend coming up with a weekend and Memorial Day. Hopefully things are opening up where you are, and whether you can get together with family or friends, or eat at a restaurant inside, or go to a ball game. Please be careful out there. Please be safe. Have a trade plan. Follow your plan. Have rules. Follow your rules, and learn how to trade. Learn how to trade with the big guys. And I hope we see you in some of our introductory or advanced workshops down the road. Have a great, safe weekend. To my support team, Shar and Nick, thank you very much for helping me out today. And I hope to see you all soon down the road. Thanks, guys. Be well. Bye-bye.